Hello everyone, a lot of talk lately about silver possibly launching into a completely different price range. And at the same time, there has been a lot of frustration from gold and silver investors because the mood out there does not match the market. So in this video, we're going to separate excitement from evidence, bold price targets from actual signals, and you are going to walk away feeling a lot smarter and more confident about what is happening in gold, silver, central banks, and the physical market. And today in New York, it is Monday, April 27th. So comment below what day and date you're watching from, because I want to see where this community is watching from. Also, if you value this work, support the channel by subscribing and comment John A.G. Best. That tells me you're here for real breakdowns and not just recycled noise. So, in case you haven't noticed the weird mood, this is what I'm talking about. Silver has already moved a long way from the levels people were complaining about years ago. Gold has been making the kind of moves that used to sound impossible. And yet, if you read the comments, you would think the whole metals market is dead. That's the first important clue. Price and mood are not the same thing. Price tells you what the market is doing. Mood tells you what people expected it to do by now. And right now, a lot of people are not mad because silver has failed. They're mad because silver has not already fulfilled the most aggressive version of their imagination. Now, that doesn't mean frustration is stupid. Silver can be brutal. It can move 10 steps forward, then punch everybody in the stomach for no reason. But when sentiment gets this sour during a strong market, I pay attention, because markets often do their best work when people are tired of believing. Recently published numbers still show a market that is not loose. The silver market is expected to remain in deficit again for the 6th year in a row, with physical investment expected to rise while some price-sensitive industrial, jewelry, and silverware demand softens. So already we have a more balanced picture. Not perfect, not magical, but still tight. And this is where the giant silver targets come in. There is a target being discussed around the low 300s per ounce. On the surface, that sounds crazy. I get it. If you tell a normal person silver could move from where it is now into that zone, they'll look at you like you just tried to sell them a moon rock. However, the number itself is not the most interesting part. The interesting part is the claim that this forecast was being discussed back when silver was still in the low 20s. That's different. A big call made after a huge rally can be hype. A big call made years before the rally at least deserves to be examined. But examined does not mean worshipped. This is where people get lost. They hear a huge target, and either they laugh it off immediately or they treat it like a guaranteed prophecy. Neither one is serious. The serious question is, what would have to happen for silver to deserve a totally different price range? First, silver would probably need to prove it can hold much higher levels without instantly collapsing. That means we may see churn. We may see pullbacks. We may see a base. And yes, that can be boring. It can be annoying. It can make people say the move is over. But sometimes a market is not dying. Sometimes it is building a floor under the next move. Think of it like a bathtub again. If the water level looks calm, that does not mean nothing is happening. Water can be flowing in underneath the surface, draining from one place, filling another, moving through pipes you don't see. Silver is like that right now. The visible price is only one part of the story. The hidden flow of physical demand, investment demand, and inventory pressure is the part that matters. Now, one thing I do not like is when people talk about extreme upside but skip the risk. If silver is going into a new range, it will probably shake out the most leveraged people first. Leverage is where people can be right and still lose. They can have the right thesis, the right asset, the right big picture, and still get wiped out because the path was uglier than they expected. So when someone says silver may go much higher, I immediately ask, okay, but can the investor survive the path? Because if the answer is no, then the target is entertainment, not a plan. The next part is the exit question. And this is where it gets even more interesting. A lot of people talk about buying silver. Very few talk clearly about what comes after a huge move. One possible future signal is not even inside the silver market. It may come from equities. Imagine a day when the stock market has been beaten down so badly that the mainstream mood says stocks are finished, equities are dead, nobody wants them, and the average investor has completely given up. That kind of moment can feel terrifying. But historically, those extreme pessimism moments can also mark the beginning of opportunity. Now please hear me carefully. A headline is not a trading system. It is not a button, it is not an instruction, but it can be a sentiment marker. If metals have already run hard and stocks are universally hated, that might be when smart money starts asking a very uncomfortable question. Is it time to rotate? And that's the point. The goal is not to marry an asset forever. The goal is to understand cycles. Gold has a cycle, silver has a cycle, stocks have a cycle, cash has a cycle, even confidence has a cycle. Now let's talk about why silver's role may be changing. Silver is not just a monetary metal anymore. It is money history plus industrial use, plus energy infrastructure, plus electronics, plus investment demand. That combination makes it volatile. But it also means multiple buyers can show up for different reasons. Based on the latest outlook, industrial silver fabrication is expected to ease, partly because solar manufacturers are thrifting and substituting where they can. And that's actually an important counterpoint. Solar demand does not mean silver demand goes straight up forever. High prices force engineers to use less. That's real. But here is the other side. Data centers, artificial intelligence infrastructure, power grids, vehicles, electronics, and investment buying are still keeping silver relevant. So the story is not everything is bullish. The story is that weakness in one demand channel is being met by strength in others. That's more realistic. Now let's bring in Asia, because this is where the physical market gets loud. Recent market updates showed China's silver imports in March jumping to a record level, far above the normal March pattern, with solar demand and retail investment both helping the move. That does not mean China is buying every ounce on Earth, but it does mean the world's largest silver consumer showed up aggressively. At the same time, China's solar panel exports hit a record in March, helped by demand from Southeast Asia and Africa, energy security concerns, and buyers trying to get ahead of price changes. So when people ask why silver matters geopolitically, that's one answer. Solar is not just a climate story, it is an energy security story. And this matters for silver because China and India are not thinking like small retail buyers. They are thinking like large economies that need power, manufacturing capacity, electronics, transportation, and resilience. If oil gets expensive, if supply routes are unstable, if energy security becomes a national priority, then metals connected to electrification become more strategic. That doesn't mean every solar panel equals a silver shortage. Again, we are not doing fantasy math here. But it does mean silver has moved from being only a coin shop conversation into a supply chain conversation. Now, one thing I want to challenge is the idea that every premium automatically proves a crisis. It doesn't. Premiums can come from taxes, shipping costs, local shortages, import timing, currency movements, and policy rules. But when premiums appear while imports are strong and inventories are being watched closely, you do not ignore it. You put it on the board. London is another place people discuss constantly. And based on the latest vault data, London still holds a very large amount of silver, along with a massive amount of gold. So no, it is not accurate to say London has nothing. But the more useful question is not, is there any metal? The useful question is, how much of that metal is actually available at the right price, in the right form, at the right time? That distinction matters. A warehouse can look full and still have a tight market if the owners do not want to sell. Inventory is not the same as available supply. And this is also why the gold to silver ratio matters, but not in the simplistic way people usually use it. People say, the ratio used to be lower, so it must go back there. Well, maybe, but must is a dangerous word. The ratio can compress because silver rises faster than gold. It can also compress because gold stalls while silver catches up. And it can widen again if fear turns pure monetary and gold gets preferred over everything else. So the ratio is a tool. It is not a promise. Still, the ratio helps us think in scenarios. If gold stays elevated and silver keeps gaining strategic importance, silver does not need a miracle to move higher. It needs gold to remain strong, inventories to stay tight, investment demand to return, and industry to keep treating silver as necessary. That is not a tiny list, but it is not impossible either. The fiscal backdrop matters too. Large deficits do not automatically send metals higher tomorrow. They can sit for years. But deficits change the way big institutions think about reserves. If governments keep borrowing heavily, and if currencies keep being used as policy weapons, then reserve managers start asking a simple question. What asset is nobody else's liability? That is gold's advantage. Silver's advantage is different. Silver is the smaller market. It is easier to push around, easier to scare, easier to squeeze, and easier to overheat. So if gold is the anchor, silver is the spring. The anchor moves, the spring can snap violently. And that's why I don't want anyone confusing bullish with careless. The bigger the target, the more discipline matters. A person with a modest target and good risk control can survive. A person with a giant target and no plan can turn a bull market into a personal disaster. Now let's shift to gold, because silver does not live alone. Gold is the anchor in this entire precious metal story. Central banks are still the adults in the room. You don't have to like them. You don't have to trust what they say. But you should absolutely watch what they do. And what they have been doing is telling us that gold still matters. The latest gold demand data shows central banks continued buying through a year of record prices, even though the pace moved around from quarter to quarter. That's important because it means the official sector did not simply disappear because gold became expensive. They adjusted, but they stayed involved. China is the cleanest example. The central bank reported another gold purchase in March, extending a buying streak that is now around a year and a half, bringing official holdings to a little over 2,000 tons. That is not retail hype. That is reserve management. But we also have to be honest about the other side. Some central banks and governments may sell gold. Russia has reportedly sold roughly a couple dozen tons this year while dealing with a large budget deficit. Is that bearish for gold? I don't think so. That's like saying a family using emergency savings proves emergency savings are useless. No, it proves they were useful. Uganda is the opposite side of the same story. Its central bank has started buying domestically produced gold under a pilot program designed to diversify reserves. A smaller country doing that may not move the whole gold market by itself, but it fits the broader pattern. Countries want reserve assets that are not just another country's paper promise. Even U.S. trade data has been flashing something interesting. Recent official figures showed non-monetary gold and other precious metals helping lift goods exports. Again, don't turn that into a movie script. But when precious metals show up meaningfully in trade flows, it tells you the metal is moving through the system with urgency. So putting this all together, how likely is silver to go straight to the low 300s without drama? In my opinion, close to zero. Not because it can't eventually get there, but because markets almost never give people the movie version. Could silver reach triple digits first? Yes, that is much easier to imagine in a world of deficits, investment demand, strong Asian imports, and monetary stress. Could it overshoot after that if the public suddenly rushes in? Also, yes, silver has a history of doing nothing for too long and then doing too much too fast. But could it also disappoint people before it rewards them? Absolutely. And that is probably the part most investors need to hear. If you're successful, share your success story in the comments so others can stay motivated. And I want to ask you this. Do you think silver's next major checkpoint is triple digits? Or do you think the market needs one more painful shakeout first? Also, if stocks eventually become hated and metals become loved, would you rotate some profits? Or would you hold no matter what? Put that in the comments, because the answer says a lot about how you think. So, here's the bottom line. The bullish case for gold and silver is not one analyst, one target, one chart, or one rumor. It is a cluster of signals: persistent deficits, physical investment, Asian demand, energy security, central bank gold behavior, fiscal stress, and the slow erosion of confidence in paper promises. That does not mean you should be reckless. It means you should be awake. Thank you for watching. Subscribe for more breakdowns like this. And remember, this is education and market discussion only. I'm not telling you what to buy, sell, or hold. I'm sharing how I understand the evidence, the risks, and the bigger picture. But your money is your responsibility. Think clearly, stay patient, and make decisions you can live with.